Welcome from San Diego, California. We are reaching you in English, Spanish, and Portuguese, live through a unique and complex international telecommunications network via satellite, microwave, and cable. The International Training Center at San Diego State University brings us together once again through this original video conference program, which joins distinguished organizations representing education, business, and government in Mexico, Cuba, the Dominican Republic, Costa Rica, Panama, Colombia, Venezuela, Peru, our friends from Ecuador and Brazil, Bolivia, Paraguay, Argentina, Spain, and the United States of America. We acknowledge the participation of the Organization of American States in Washington, D.C., and the United Nations Conference on Trade and Development, located in Geneva, Switzerland. Hello, my name is Dan Hopwood, and I am the moderator for today's program. I am the Director of Risk Consulting for the professional services firm of Barney & Barney, LLC, located in San Diego, California. We specialize in business insurance program development, placement, and management consulting, including the areas of risk management, safety and health, and business continuity management. As the ITC continues the series on global strategies for excellence, value, and optimal performance, you will be introduced to the topics of risk management, briefly touched upon in previous programs, as well as business continuity management. Today's program will take you deeper into the roles risk and business continuity management play in helping an organization develop its operational strategies, now and for the future. Additionally, you will learn that both risk management and business continuity play an integral part in creating your organizational value and optimizing performance. You ask how? Well, I don't want to give away the secrets of our presenters, nor do I want to oversimplify their underlying concepts. But allow me to provide a few introductory thoughts. First, risk and business continuity management. Though distinct fields of practice, have significant similarities due to their theoretical approaches. In these approaches, they seek to help organizations qualify and further quantify threats to their operations. Threats, whether they be natural or technical, human or contingent, must be identified, and some efforts must be made to control them. Risk and business continuity management do just that. In addition, through risk management, we strive to determine and implement financial and operational methodologies to transfer risk away from an organization while business continuity seeks to achieve the successful management of emergencies, crises, and disasters. Both have the ultimate goal of maintaining or continuing business operations, even in the face of a threat that has arisen. Lastly, we are taking a unique approach today in that we are merging the topics of risk management and business continuity management, bringing the two together. In essence, we are saying that business continuity is the sound application of risk management thought. In a moment, you'll hear John Watson's opening comment. Risk management begins with a philosophy, a way of thinking about the future. To that extent, that future is indicative of change. John's comment on adopting a philosophy is very sound advice. While John provides a sketch on the philosophy and logical approach to considering the future via risk management, on a canvas, if you will, a canvas that needs to be painted, Jim Pinzari will provide that paint. His discussion of business continuity will add detail and will add color to the foundation that John will lay for us. The topics of risk and business continuity management are near and dear to my heart. This is for two reasons, actually three as of yesterday. Not only do I consult in these fields, but I am convinced that the two disciplines are essential for organizations to structurally integrate into their operations and future considerations. Not doing so will mean organizations are relying on luck, sheer luck, to survive any threat that their operations may develop. This integration, to achieve ultimate success, must be organic. That is, it has to be woven into the fabric of your operations. And once started, activities supporting these disciplines must be perpetuated. Risk management and business continuity management are not one and the same. We have, however, chosen to strategically link them in this conference. To do so is aggressive and essential. I am confident you will agree with that assessment after this program. Our presenters today bring us a unique blend of experiences and qualifications. Both hold the United States' highest designations in their fields of practice. Both have consulted to some of the U.S.'s largest organizations and academic institutions, and they are each recognized for their leaderships in the fields of risk management and business continuity management. I am pleased to introduce two gentlemen and friends that I have had the distinct pleasure to work with, John Watson and Jim Pinzari. John and I met while sharing the podium at a conference in 1999, and John holds the ARM, the Associate in Risk Management, a national designation signifying expertise in the field of risk management and its primary tenets, risk financing and risk control. In addition, John holds the CIC, or the Certified Insurance Counselor designation, critical in that risk management and insurance have essentially strong bonds. John has co-authored a text on disaster management, widely used in the academic community in the United States. More importantly, John is a day-to-day practitioner of risk management. He really lives this, as he is responsible for the risk management and insurance functions at one of California's and this country's premier academic institutions, Pepperdine University. Thus, John will be able to discuss with us the true applied aspects of risk management and one method of delivery, business continuity management. I was fortunate to work with and for Jim for several years while I was employed with his firm, Marsh Risk Consulting. Jim oversees the National Business Continuity Management Consulting practice for Marsh Risk Consulting, an international firm that has placed great resources in its field operations to assist their clients with business continuity efforts. Jim holds the Certified Business Continuity Professional designation, the CBCP, an international certification that signifies understanding of business continuity needs, and more importantly, the ability to apply tactics enabling organizations to withstand the manifestations of emergencies, crises, or disasters. Jim and his team have consulted with many of the largest U.S. and international companies. Gentlemen, welcome. And I'd like to begin with a question, if I may, today. How does risk management and business continuity planning relate to the traditional approach of contracting commercial insurance policies and then creating emergency response programs? And further, is risk management for everybody, even for smaller organizations? And John, if you wouldn't mind taking the front half of that question and talking about the placement of insurance policies and emergency response programs and sort of how they come together. And Jim, I'd like to come to you for the second piece. So John, go ahead.
Well, traditionally, insurance was looked upon as a commodity purchase, whereas in the risk management process, insurance is an outcome of the risk management process. The involvement of pre-loss, post-loss activities are integral to the underwriting and acquisition of an insurance contract and are the essence of the outcome of the process and not the commodity purchase at the beginning.
So what you're saying is that the post-loss aspect of insurance critically engages emergency response?
Absolutely.
Okay, good. So Jim, let's have a follow-up in terms of the second half of that question.
In talking about the emergency response programs and relating to the business continuity planning, emergency response is a very critical component, but only one critical component of business continuity planning. If you think about emergency response, it's really the initial phase that you react to during an incident in which you stabilize, control the situation. And that's about as far as it goes. What you need to do is you need to have an additional part of the plan involving crisis communications and business recovery that you can use to get your business up and running again.
Take that just briefly, Jim, if you will, and tell me and the listening audience how it works for smaller organizations. What's the value to a small organization? Is it the same as a large one?
At Marsh Risk Consulting, we deal with many large multinational companies as well as small emerging growth companies. That's a good question, because if you're a small company today, you don't have the large organizational structure that some of the larger companies have. So to become involved in business continuity planning early on in the development of your company is very important, and it's a much easier process to get involved with, and then as your company grows, to maintain that.
Good, good. So this really begins the groundswell. The smaller the organization, we can practice, and we can move things through. Gentlemen, thank you for your answers. Let's begin now with Module 1, in which John Watson will present the principles behind risk management.
Thank you. Risk management begins with a philosophy, a way of thinking about the future, recognizing and investigating threats to an organization's assets, designing systems to measure and manage acceptable risk and to avoid unacceptable risk. Risk management is an integral part of the modern management matrix. Risk management enhances cash flow by treating risk exposures efficiently in keeping with the public interest, human safety, environmental concerns, legal realities, and commercial ethics. The best risk managers are talented and experienced business people. They draw on diverse skills and disciplines to preserve resources, earnings, service capacity, and operating efficiency. First and foremost, the risk manager must be a good communicator. He or she must be capable of coordinating and interfacing with other departments. The position requires regular contact with departments such as legal, finance, audit, human resources, engineering, safety, security, and research and development. It also involves selecting and coordinating the services of external professionals such as insurance agents and brokers, insurance companies, attorneys, consultants, and other service providers. In addition to understanding these varied specialties, the risk manager must master the complexities of the organization's own operations, interpreting the adverse effects of new technologies and government regulations, uncovering hidden liabilities in mergers and acquisitions, planning for the aftermath of natural and man-made disasters, clarifying employee benefits, and addressing worker safety and productivity challenges. Risk management evolved from a structured approach to buying insurance. Much of its early use was in the smokestack industries. Today, risk management concepts are applied by strategic planners throughout industry, service, nonprofit, and public sector organizations. Today, you can find risk management departments in universities and hospitals, within the chemical industry, and among manufacturing and retailing establishments. Risk management departments are also found among airlines, banks, government agencies, municipalities, and school districts. As organizations differ, so do the types of risks and losses they may incur. For example, in addition to protecting people, physical premises, and inventory, a retail store may seek to minimize shoplifting and vandalism. A factory using hazardous substances may be concerned with an employee safety and could issue protective clothing and equipment and provide specialized training. What are risks? Risk exposures generally fall within one or more of 5 categories: operating, legal and regulatory, financial, political and reputational, and technology. Operating risks are those threats that arise out of the operations of the business. For my organization, Pepperdine University, located in Los Angeles, California, these operations would typically include teaching, research, and owning and operating the premises, including providing employment, food, housing, transportation, safety, and security. Operating risks include the potential loss of housing, the loss of key employees, the inability to provide food or shelter, and even the inability to open for classes. For an oil refinery, the operating risks would include the inability to obtain crude oil or to transport the finished products, and breakdowns in the refinery process. Legal and regulatory risks arise from the numerous laws and regulations with which business and industry must comply, such as those required by the U.S. Occupational Safety and Health Act or the Environmental Protection Agency, various civil rights regulations, and other federal, state, and local laws. Corporations and local and state government agencies that fail to comply with these laws and regulations may experience losses through fines, revocation of tax incentives, or the forced closure of a facility. Government-operated businesses that are transitioning to private enterprise need to be especially careful to determine if they will be assuming the legal and regulatory risk for prior acts or previously manufactured products to which they were previously immune as a government agency. Financial risk is the potential for loss of assets. For most organizations, including government agencies, this would include physical damage to their facilities and theft of the organization's property. For corporations, this could result in a loss of stock value due to the payment of assets to third parties as a result of civil liability on a wide range of risks, from patent infringement to product defects. Reputational risk is the potential decrease in stature of the organization in the opinion of lawmakers or the general public. An organization's market position or stature in the business community can be seriously affected if the organization fails to act appropriately or in a timely manner during a product defect incident. Such was the case with the Coca-Cola incident in Belgium. Contrast Coke's loss of market with McNeil Consumer Products' retention of market share during its Tylenol capsule tampering threat in the U.S. in the 1980s. On the other hand, a local or regional government could lose tourist trade if potential visitors perceive that their region is not safe, and a university could experience decreased enrollment if it's perceived to have inadequately addressed the problem of binge drinking and thus has resulted in a student's death. For a corporation operating in an unstable foreign domicile, political risk would include confiscation of the organization's assets and terrorist actions. It seems that new areas of risk present themselves daily in the area of technology. Whether it is having a website pirated, the disruption of e-business transactions, or the invasion and modification of records, the rapidly changing world of technology is a new risk area for all organizations. These 5 categories of risk are not only of concern to the risk manager, but also to the organization's administrators, employees, and governing board or board of directors. The categories should be assessed jointly as part of an integrated approach to managing the organization's risks. For example, a hotel or resort operator would have the following potential risks: operational risks, such as slips and falls on the premises; legal and regulatory risks, such as compliance with fire codes, financial risks, which could include loss to the operator in the event of damage to a facility, reputational loss, where there develops a poor public perception of the operator if, for example, a guest is seriously injured at the resort, and technological loss, which would include the failure of any number of automated systems, including reservations, payroll, PBX, and heating and air conditioning. If the resort were to sustain a fire, the impact might be a shortage of available rooms for confirmed guests, fines for being out of compliance with life safety codes, damage to the reputation of the resort operator, and financial loss due to reduced rental income and to building repair costs. The resort operator may even have to pay claims for negligence for injury or death to guests. With all this risk, how do you start to preserve life, property, and income? I propose that you consider the risk management process. The three major components of the risk management process are to identify the potential hazards, analyze the effects of a loss, and apply risk management techniques. Let's look at the process a little more closely. The first component in the risk management process is to identify possible hazards. The range of identification methods varies from elementary to highly sophisticated. It is essential to work in conjunction with those individuals who best know an operation in order to conduct an accurate assessment of the exposures. Among the assessment methods are site inspections, loss analysis of prior incidents, checklists, which are a good source to benchmark against established standards, flow analysis, which may identify interrelated operational dependencies, surveys and questionnaires, which are useful in identifying exposures to specific risks, financial statements, which may point out continuing operations expense exposures, such as mortgage obligations, that would continue even though a loss occurs. Assessments would also include examination of other organizational records and documents, such as leases, bid documents, purchase orders, waivers, and policy statements, which may help one identify language, either included or omitted, that could be detrimental to the organization. And finally, there are times when the identification process occurs as a result of a particular situation or in reaction to an event that has already occurred. Specialty consultants may be called upon to pinpoint unusual risks and to help design sophisticated protection programs. The risk manager must know whom to call and when, drawing on expertise in the insurance field and any number of business technologies. How can we anticipate risk? Since all risk is not created equal, each risk must be evaluated for its potential significance. A determination must be made as to the extent a loss might reasonably be expected to interfere with the operations of the organization in achieving its basic objectives. Two factors can be used to benchmark a risk: frequency and severity. A four-quadrant matrix is sufficient to categorize the potential combinations of frequency and severity. For most risks, frequency and severity tend to be inversely related. For example, a major flood can be highly devastating to a facility, but the likelihood that this will routinely occur is very low. This is the category of risk exposure, low frequency and high severity, that you would try to reduce or transfer by insurance or contract. Conversely, damage to a fleet of vehicles from collision is relatively routine, and for most organizations, the combined total of the losses would not be considered catastrophic. These high-frequency, low-severity risk exposures are the ones that you would attempt to reduce. Most organizations would retain the resulting financial cost of losses, but it's important to remember that it may often be just as financially detrimental to an organization if numerous small losses occur with sufficient frequency to be more costly than a single major event. The determination of frequency and severity can be an exacting mathematical process best left to actuaries. However, familiarity with one's own business, the competition, and the business environment can usually produce acceptable conclusions. Insurance brokers and underwriters can be a good source for statistically significant historical loss data to benchmark against one's own experience. This begins the process of identifying where you may suffer a potential loss. The second component in the risk management process is to analyze the effects of a loss and determine the best options to use in response to a given exposure. Risk management options fall into two major categories: risk control and risk financing. Risk control options work to lessen opportunities for loss to occur, while risk financing options focus on who pays for losses that do occur. Since the best time to prevent a loss is before it occurs, risk control should be the first consideration for any exposure, and then, if the selected methods cannot fully protect the organization from a loss, risk financing options should be combined with appropriate risk control. Risk control methods, including avoidance, prevention, reduction, separation, duplication, and contractual transfer. The easiest way to control risk is to avoid it. The threat associated with some activities may be determined to be too great. However, avoidance is not often a viable option. For example, in an academic environment that is designed to foster exploration and the advancement of knowledge, it isn't practical to lock the perimeter gates and keep everyone off our campus, even though it would provide a huge reduction in our risk. Likewise, for a manufacturer, it may not be reasonable to discontinue a product due to loss of market share, yet that is what several U.S. firms did when they discontinued the manufacture of single-engine personal aircraft due to the inability to obtain products liability insurance. Since avoiding risk is usually not practical, what options are available? A number of studies have shown that 95% of all accidents have their root cause in a human action or inaction and are therefore preventable. Examples of loss prevention efforts include safety training to reduce back injuries, driver training programs to reduce collisions, routine equipment maintenance to prevent breakdown, and facility fire safety inspections to prevent accumulation of combustibles. Proactive loss control is the foundation of a strong risk management program.